Your most recent note was diving in on capex spending intentions. What were the sectors that stood out for you, and the overall themes?
So the overall data actually showed slight improvement from what we were seeing previously. So we do this every 3 months. We look at what the capital spending numbers are intended of 760 non-financial companies that our analysts cover in the U.S. So really just drawing what the companies are indicating. And I'm going to take energy out, and we'll come back to that. Up 6.6%. For 2019 versus 2018, that's improvement from 6.1% 3 months ago and 4.2% 6 months ago. So companies actually have kind of indicated that they are going to pick up some of their capital spending. Consumer discretionary is a strong leader there. Industrials, particularly capital goods, were pretty good in there. Areas where we've seen some weakness, surprisingly, IT has pulled back. So tech, hardware, and semis have actually cut back some of their capital spending numbers. In semis, that's actually really good news because it tends to drive chip pricing higher and supports the stock prices. Healthcare, particularly pharma, went from over 18% to 9%, maybe partially as a result of some political backdrop. And the energy side was down, but that was expected because there was a lot of pipeline work being done last year and this year to fix some bottlenecks, so that'll slip. Our biggest concern, though, is that late this year we could see some pullbacks. And
typically, headline numbers are good. Does this boost the economy in the quarter to come, or the year to come, or the stock market?
It should help us in the next couple of quarters, or the current quarter and the next quarter. I am concerned that because we had very tightening financial conditions in the fourth quarter last year, as the markets pulled back, as spreads kind of widen, there's a 9-month lag. So by the late third quarter into the fourth quarter, we may have a bit of a wobble economically.
Switching focus to trade, on May 7th, you wrote that a deal is still very likely. Is that still your view today?
So I think over time, yes. I mean, the president has shown in the past his willingness to do tweets as a form of negotiating in the public spectrum. And I think both countries kind of want a deal. There's also this political element of it, separate from, what is the best business or economic outcome. But there's a political element of both sides trying to show to their constituents and their populations they're fighting for that every inch. So our sense is that there will be a deal. The exact timing of it and the exact contours of it are still up in the air. But don't worry, if there is a deal, we will be told it is the best deal ever, right? That will come out certainly in another tweet.
So what are you expecting for the markets, and how are we investing in this uncertain time? I mean, if you're expecting a wobble later on in the year economically, and right now we have the uncertainty of all the trade headlines, what do you do?
So it's a tougher market. 2.5, 3 weeks ago, we put out a note talking about complacency in the market. And we saw it in our panic euphoria model, proprietary models at 0.33, 0.38 would get you to euphoria. We'd been there in September of last year, for instance. And that would be really worrisome. So just there's complacency. And you kind of could hear it. People were raising their targets. You were seeing discussions about melt-ups in markets. And the whole tone of the market was different 3 weeks ago. And we raised that spectrum saying, hey, there's some risk and there's vulnerability. Now, we didn't expect if it was the transitory comments from the Fed or the trade issues that would be the catalyst. Our target is 28.50. We thought we'd go above that earlier part of the year.
Year-end target is 28.50.
Yeah, we're not pounding bulls, sorry. With this weight, I can't really run that fast anyway. But the context of you don't really have the greatest setup anymore. You did earlier in the year, where sentiment was very depressed, where earnings could be beaten on the first and second quarter. Now it's going to be a little bit tougher. So it's more about trading within the market.